Friends, thank you for being here today. What if I told you that the financial stability you see in the headlines right now is nothing more than an elaborate illusion? That the banks smiling in their quarterly earnings calls are simultaneously preparing their legal teams for what they privately call the event? What if the calm we're experiencing right now isn't recovery, it's the eye of the storm? I need you to understand something that very few people are willing to say out loud. We are standing at the edge of a mathematical certainty. This isn't speculation. This isn't doom mongering. This is arithmetic, and the numbers don't lie. According to the Bank of Canada's own data, 60% of all outstanding mortgages in this country will renew by the end of 2026. 60%. Let that sink in for a moment. We're not talking about a small subset of risky borrowers or a niche corner of the market. We're talking about the majority, the core, of Canadian household debt hitting a renewal wall at interest rates that are double, sometimes triple, what these families locked in during the pandemic. But here's where it gets truly staggering. The Canadian Imperial Bank of Commerce just released a report that should have been front page news everywhere. They're warning explicitly that what they call payment shock will double in 2026. Double. CIBC isn't some fringe analyst or conspiracy theorist. This is one of the country's largest banks with access to millions of customer accounts, looking at their own portfolio and sounding the alarm. And if you read between the lines of their carefully worded report, what they're really saying is this: the system is breaking, and we can see the fracture spreading in real time. Let me give you the scale of what we're facing. In Ontario alone, the beating heart of Canada's housing bubble, mortgage delinquency rates surged by 44% year over year in the second quarter of 2025. Not 4%, 44%. This is a localized earthquake that the national averages are hiding. The official numbers look stable because of how the data is aggregated, but when you drill down into the epicenter, you see the ground opening up beneath people's feet. And it gets worse. Among subprime borrowers, the people who were already walking the tightrope, delinquency rates have climbed to 11.5% for payments that are 30 days or more overdue. That's notably higher than pre-COVID levels, according to CIBC's own analysis. Now, why does this matter if you're not a subprime borrower? Because distress doesn't stay contained. It starts at the bottom and works its way up. The subprime borrowers are the canaries in the coal mine. They fall first. Then the renters, whose delinquency rates are also climbing. And finally, in 2026, the prime mortgage holders who thought they were safe will discover they're not immune to the laws of mathematics. This is a structural fault line, friends, not a correction, not a downturn, a fault line that has been building pressure for years, and the release is coming. Now, before we go further, I need to take you back to understand how we arrived at this moment, because this crisis didn't start yesterday. It didn't start with the Bank of Canada's rate hikes. This is the final act of a tragedy that began during the pandemic. And if you don't understand the origin, you won't grasp why what's coming is inevitable. Let's go back to 2020 and 2021. Do you remember what you were told? Interest rates were going to stay low for a very long time. Central bankers said it explicitly. Governments pumped unprecedented stimulus into the economy. Housing prices were soaring. And Canadians, rational people trying to secure a future for their families, did what they thought was the smart thing. They bought homes, expensive homes, with cheap money. Think of it like this. Imagine you're offered a mortgage at 1.5%. Your monthly payment on a $600,000 home is maybe $2,650. It's tight, but you can manage it. The bank approves you. The realtor congratulates you. You move in. Life is good. But here's what nobody explained clearly. Those weren't permanent rates. They were 5-year fixed terms or variable rates tied to overnight lending rates that could and would change. Fast forward to today. That same mortgage, when it renews in 2026, isn't renewing at 1.5%. It's renewing at 4.5%, maybe 5%. Suddenly, your payment isn't $2,650 anymore. It's $3,150. That's an extra $500 a month, $6,000 a year coming out of your household budget. For families already squeezed by grocery inflation, by rising insurance costs, by the cumulative weight of everything costing more, this isn't an inconvenience. It's a budget breaker. It's the difference between making it and not making it. And here's the mechanism that makes this truly insidious. What I call the system's most crucial secret. For the past few years, many variable rate mortgage holders have been allowed to engage in something called negative amortization. Let me simplify this for you because it sounds technical, but it's actually quite sinister. Imagine you're treading water in the middle of a lake. You're tired, but you're staying afloat. Now imagine the bank hands you a lead weight and says, "Here, hold this, but don't worry, you can keep treading water." That's negative amortization. These borrowers were allowed to pay only the interest on their loans, or in some cases, even less than the interest. The unpaid portion, it got added to the principal. Their debt was growing every single month, but they were technically current on their payments. The bank's books looked clean. The default statistics looked manageable. Everyone pretended the problem didn't exist. But in 2026, the game ends. The negative amortization arrangements expire. These borrowers have to start paying down the principal again at much higher interest rates. The life jacket is being taken away, and they're being told to swim to shore with that lead weight still strapped to their chest. Now, you might be thinking, but the banks must have stress tested for this. They must have been prepared. And you'd be right, they did stress test. But here's what they didn't account for: the sheer scale of the convergence. CIBC's report admits that for 5 to 6% of their mortgage portfolio, payments could jump by more than 40%. They're not talking about a small number of problem accounts. They're talking about potentially billions of dollars in loans that are on the edge. And let me tell you something else that should concern you. CIBC just settled a class action lawsuit over unpaid overtime for $153 million. That might sound like big news, but it's a distraction. What you need to pay attention to is what they're doing behind the scenes. They're restructuring their workforce. They're taking charges to prepare for loan losses. They're building up their legal and collections departments. When a bank starts preparing its infrastructure for mass defaults, that's not speculation. That's operational reality. This leads us to the question you're probably asking right now. Why go through this elaborate charade? Why let people pay interest only for years? Why not force the reckoning sooner? The answer is discipline, or rather the lack of it. The banks needed to keep official delinquency numbers low. They needed to prevent panic. They needed to maintain the illusion of stability while they quietly prepared for what they knew was coming. It's a strategy called extend and pretend. Kick the can down the road, hope something changes, and prepare for the worst in private. But the math doesn't lie, friends, and the math is breaking. Let me show you the canaries that are already dying in the coal mine. First, look at auto loans. Auto loan delinquencies are spiking, especially among younger borrowers. We're seeing increases of nearly 20% year over year. Now, think about what that tells us. If people can't afford the payment on their car, the vehicle they need to get to work, what makes you think they'll be able to afford a 40% increase in their mortgage payment? The car loan is the first thing to go because losing your car is painful, but you can take the bus. Losing your home, that's catastrophic. But when you're already underwater on the car, the mortgage default is just a matter of time. Second canary, Generation Z credit usage. The future generation of home buyers is drowning in debt before they even get to the housing market. Their credit usage is growing rapidly, and so are their delinquency rates. These aren't people with $1 million mortgages yet. These are people with credit cards, student loans, and car payments. If the next generation can't manage their current debt load, what happens when they try to enter a housing market where prices are still elevated and interest rates are structurally higher than the past decade? Third canary, that Ontario spike I mentioned earlier. 44% year-over-year increase in mortgage delinquencies. Ontario contains Toronto, the largest city in Canada, and some of the most expensive real estate in the country. When you see that kind of surge in the epicenter of the bubble, you're not looking at noise. You're looking at the foundation starting to crumble. Now let's talk about the trigger event, the specific moment when this structure is going to snap. We're not talking about some distant theoretical future. We're talking about late 2025 and early 2026. That's when the renewal wall hits with full force. That's when millions of Canadian households are going to open their mortgage renewal letters and see numbers that make their stomach drop. Picture this. You're a family in suburban Toronto. You bought your home in 2021 for $800,000 with a 5-year fixed rate at 1.7%. Your payment has been manageable, maybe $2,800 a month. You've been careful. You've been responsible. You haven't missed a payment. And then the letter arrives. Your renewal rate is 4.8%. Your new payment is $3,700 a month. That's $900 more every single month. Where does that money come from? You cut back on groceries, but groceries already cost more. You cancel the kids' activities. You stop eating out entirely. You drain your savings. And maybe, just maybe, you hold on. But then your property taxes go up. Your home insurance renews at a higher rate. Your car needs repairs. Your kid needs braces. And suddenly that $900 gap becomes insurmountable. You call the bank. You ask for options. And the bank, which has been so friendly for the past 5 years, suddenly becomes very professional, very clinical. They've prepared for this conversation. They have a script. They have a process. They have lawyers. This isn't one family's story, friends. This is the story of hundreds of thousands of families across this country. And each one of those stories represents a consumption collapse. Because when you take $6,000 to $10,000 per year out of a household budget, that money doesn't go to restaurants or car dealerships or home renovations or retail stores. That money disappears from the economy. It goes straight to the banks to service debt that has suddenly become crushing. And here's what makes this a true crisis rather than just a difficult adjustment. There is no escape hatch. Let me walk you through the scenarios. Scenario 1, interest rates stay high. If the Bank of Canada keeps rates elevated because inflation remains sticky or because they're worried about currency depreciation, then the renewal shock hits at full force. Mass defaults, foreclosures. The housing market floods with distressed properties. Prices collapse. Everyone who bought in the past 5 years is underwater. Negative equity becomes widespread. The banks take massive losses. Credit tightens even further. The economy spirals. Scenario 2, interest rates drop slightly. Let's say the Bank of Canada gets spooked by the early warning signs and cuts rates back down to 3 or 3.5%. Sounds like good news, right? Wrong. Because even at 3.5%, you're still paying more than double what you locked in at 1.5%. Your payment still jumps by 40 or 50%. It's not as catastrophic as scenario 1, but it's still a budget breaker for millions of families. The shock is delayed, not prevented. Scenario 3, interest rates drop dramatically back to pandemic levels. This is the fantasy scenario that people are hoping for. But let me tell you why this won't happen, can't happen. If the Bank of Canada drops rates back to near zero, they're admitting that the economy is in such dire straits that emergency measures are required again. And if rates go back to near zero, what happens to the Canadian dollar? It collapses. What happens to inflation? It reignites. What happens to Canada's credibility in international bond markets? It evaporates. The vigilantes in the bond market, the institutional investors who buy Canadian government debt, will demand higher yields to compensate for the risk. And suddenly, even if the Bank of Canada drops their policy rate, mortgage rates don't follow because the bond market is pricing in default risk. Do you see the trap? There is no painless way out of this. The era of free money is over, and the hangover is just beginning. The simple logic of rates will go back down and everything will be fine does not apply. We are in a new paradigm and most people haven't adjusted their mental models yet. Let me give you another piece of forensic evidence that proves the rot is real. Look at what's happening in the auto lending space, specifically the collapse of subprime auto lenders. Do you remember a company called Truelocity? Probably not, unless you follow obscure corners of the credit markets. Truelocity was a subprime auto lender in the United States that collapsed when credit lines froze. They were writing loans to people with damaged credit, charging high interest rates, and securitizing those loans to sell to investors. It worked beautifully when money was cheap and plentiful, but when liquidity dried up, when investors stopped buying those securitized packages, the whole operation imploded virtually overnight. Now, we haven't seen a major Canadian equivalent fail yet, emphasis on yet, but the mechanics are identical. Subprime lenders operate on razor-thin margins. They need constant access to credit lines to keep writing new loans. When those credit lines get pulled, or when the cost of capital rises too high, the business model breaks. And when subprime lenders start failing, it's not because they were uniquely reckless. It's because they're the first domino. They're the most vulnerable part of a system that's under stress everywhere. The same principle applies to mortgages. Subprime mortgage borrowers are already showing delinquency rates of 11.5%. That's the leading edge. But prime borrowers aren't immune. They're just delayed. When a prime borrower faces a 40% payment increase, the only difference between them and a subprime borrower is that they have a few more months of savings to burn through before they default. The destination is the same. It's just a matter of timing. And here's something else you need to understand about how this contagion spreads. It's not just about individual borrowers defaulting. It's about what happens to the broader economy when millions of people simultaneously cut their spending. Think about the ripple effects. When mortgage payments spike, people stop buying new cars. We're already seeing it in the auto loan data. When people stop buying cars, dealerships struggle. When dealerships struggle, they lay off workers. When workers get laid off, they can't pay their mortgages. The cycle feeds itself. The same thing happens in retail, in restaurants, in construction, in every sector that depends on consumer spending, which is approximately 70% of the Canadian economy. This isn't just a housing crisis. This is a consumption crisis that starts with housing and metastasizes into everything else. Now, I told you earlier that this leads us to the system's most crucial secret, and here it is. The banks are not your partners. I know they market themselves that way. I know the commercials show smiling families and helpful advisors. I know your mortgage broker told you they were there to help. But when the crisis hits, when the numbers stop working, the bank is not on your side. The bank is a creditor. They have a legal obligation to their shareholders, not to you. And they are preparing right now in boardrooms and legal departments across the country for the moment when they have to start taking houses back. CIBC's workforce restructuring isn't about efficiency, it's about capacity. They're building the infrastructure to handle mass defaults. They're hiring more people in collections. They're preparing their legal teams. They're setting aside reserves for loan losses. This is operational preparation for a foreclosure wave that they can see coming in their own data. And here's the truly disturbing part. This is all rational from the bank's perspective. They're doing exactly what they should be doing. They're looking at their portfolio, seeing the risk, and preparing for it. The problem is that their preparation is an admission. When banks start acting like a crisis is coming, it becomes a self-fulfilling prophecy because other lenders see what they're doing and tighten their own standards, which makes it harder for borderline borrowers to refinance, which increases default rates, which validates the bank's initial concern. The feedback loop is vicious and accelerating. Let me paint you a picture of what the second half of 2026 could look like. The renewal wave has hit. Payment shock has doubled. Just like CIBC warned, families who thought they'd have more time suddenly don't. The default rate starts climbing, first slowly, then rapidly. The banks, which have been extending and pretending for years, suddenly stop pretending. They start enforcing the terms of their contracts. Foreclosure notices begin arriving. Real estate agents start getting calls from desperate sellers trying to unload properties before the bank takes them. The number of listings surges. Buyers, seeing the flood of supply and knowing more is coming, hold back. They wait for lower prices, which causes prices to drop further, which puts more homeowners underwater, which triggers more defaults. The government watching this unfold faces an impossible choice. Do they intervene to save homeowners? If so, who pays for it? Taxpayers? That's politically toxic. Do they force banks to extend more forbearance? That undermines the entire mortgage market and makes international investors nervous about Canadian debt. Do they drop interest rates in a panic? That risks reigniting inflation and collapsing the currency. There is no good option. Every path leads to pain. The only question is who bears it. Now let's talk about the convergence, the moment when all of these forces hit at once, because what we're facing isn't just one problem. It's three distinct crises colliding in the same window of time, creating what I call the trifecta of inevitability. Force number one, the 2026 renewal wall. 60% of mortgages, millions of families, payment increases of 40 to 50%. We've covered this extensively, but I need you to hold this number in your mind as the foundation of everything else. Force number two, subprime deterioration. The 11.5% delinquency rate among subprime borrowers isn't stabilizing, it's climbing. This is the contagion vector. What starts at the bottom spreads upward. Every subprime default tightens credit conditions for everyone else. Every foreclosure adds to housing supply. Every distressed sale pushes prices lower. The deterioration at the margins creates the conditions for deterioration at the core. Force number three, economic slowdown and rising unemployment. Here's what nobody wants to talk about openly. Canada's economy is slowing. Job growth is weakening. Unemployment is ticking up. It's still low by historical standards, but the trajectory is concerning. And here's why this matters in the context of mortgages. When someone loses their job, their ability to pay their mortgage doesn't depend on interest rates anymore. It goes to zero. Even if rates drop tomorrow, an unemployed person can't make payments. And when unemployment rises during a period of mass mortgage renewals, you get a doom loop. Layoffs cause defaults. Defaults cause economic contraction. Contraction causes more layoffs. These three forces aren't happening in isolation. They're happening simultaneously and they're reinforcing each other. This is the convergence. This is the structural break that cannot be papered over with more extend and pretend accounting tricks. But here's where I need to shift gears and talk to you not about the banks, not about the economy, but about you, about your mind, because the biggest threat you face right now isn't just the mathematics of debt, it's your own psychology. Human beings are hardwired to believe that tomorrow will look like yesterday. It's called normalcy bias, and it's one of the most dangerous cognitive traps in existence. Your brain looks at the past 5 years and says, well, we made it through so far. The bank worked with us before. The government stepped in during COVID. Something will happen to fix this. And that belief, that reasonable, understandable, very human belief, will destroy you financially if you let it guide your decisions right now. Because this time is different, not in the way that phrase is usually used as a joke in financial markets. I mean, it's structurally, mathematically, fundamentally different. The COVID crisis was a shock that governments could address with monetary and fiscal stimulus. They could print money, drop rates to zero, and flood the system with liquidity because inflation was dormant. They had the ammunition, they used it, it worked, sort of. But that ammunition is gone now. The government's debt to GDP ratio is already elevated. Inflation is still lurking. The political will for massive bailouts has evaporated. And even if they wanted to intervene, the scale of what's coming is too large. You cannot bail out 60% of mortgage holders without destroying the currency and the bond market. It's mathematically impossible. So when you tell yourself they'll figure something out, they always do, I need you to understand that you're engaging in magical thinking. The cavalry isn't coming. The last-minute rescue isn't happening. The extend and pretend game is ending because the math has finally broken through the facade. Let me introduce you to another concept, the money illusion. This is the psychological phenomenon where you focus on the nominal value of your assets instead of their real purchasing power. Your house is worth $800,000 on paper. That number makes you feel wealthy. You became a millionaire on paper. But what can you actually buy with that equity? If you sold today, could you afford to buy a comparable house? If prices drop 30%, does your net worth matter if you're locked into a mortgage you can't afford? The money illusion makes you feel rich when you're actually getting poorer. Your home's value might be up $200,000 since you bought it, but your groceries cost 50% more. Your insurance doubled, your property taxes climbed, and your mortgage payment is about to jump 40%. You're a millionaire on paper and broke at the grocery store. That's the illusion, and the illusion is shattering in real time. So what do? Let me be very clear about the binary choice you face right now. On one side, you have paper assets, you have claims on value, your stocks, your ETFs, your mutual funds in your RRSP. These are all denominated in currency that can be printed in companies whose earnings depend on consumer spending that's about to evaporate. Your mortgage is a liability denominated in that same currency, but it's a liability you can't print your way out of. You owe a specific dollar amount, and when your income drops or your payment spikes, those paper assets don't save you. You can't pay your mortgage with your stock portfolio unless you sell. And if you're forced to sell into a declining market, you're locking in losses. On the other side, you have real assets. You have things that hold intrinsic value regardless of what happens to currency or credit markets. Gold, silver, land that's paid off, tangible goods. These aren't investments in the traditional sense. They're insurance. They're ways of stepping out of the line of fire. Now, I'm not telling you to sell everything and buy gold bars tomorrow. What I'm telling you is this. You need to understand the difference between owning an asset and owning a claim on an asset. You need to understand that debt, all debt, but especially mortgage debt at these levels, is a claim on your future income. And when the system reprices risk, when the extend and pretend game ends, the people holding debt are going to be crushed while the people holding assets will survive. Let me be specific about what preparation looks like in this environment. If you have a mortgage renewing in 2026, you need to be stress testing your budget right now for a 40 to 50% payment increase, not hoping it won't happen, not assuming rates will drop, planning for the worst case scenario. If you can't afford the increased payment, you have two options. Start aggressively paying down principal now to reduce your balance, or sell before the flood of distressed listings hits the market. I know that sounds dramatic. I know it sounds like panic, but selling voluntarily at today's prices is infinitely better than being forced to sell at tomorrow's prices or losing the house to foreclosure. If you have variable debt, credit cards, lines of credit, car loans, pay it down aggressively, ruthlessly, because when the crisis hits, when the banks start tightening credit, those lines of credit you've been relying on will get pulled. The credit card limit you thought was available will be reduced. The HELOC you plan to tap for emergencies will be frozen. The banks are preparing for this, and you need to prepare too. And if you have cash savings, understand that cash is not safety, it's optionality. Cash loses value to inflation every day it sits in a bank account earning 2%, while real inflation runs higher. But cash gives you the ability to act when opportunities arise. When the foreclosure wave hits and houses are selling at fire sale prices, cash is king. When businesses fail and assets get liquidated, cash is power. The question is, how much of your cash do you convert to hard assets now versus how much do you hold for opportunities later? That's a personal decision based on your risk tolerance and timeline, but you need to be thinking about it. Here's what I want you to understand about gold and silver in this context. These aren't speculations on price appreciation. Gold doesn't pay a dividend. Silver doesn't generate cash flow, but they are the only financial assets that are nobody else's liability. When you own physical gold, you're not dependent on a bank staying solvent, or a government honoring its bonds, or a corporation generating profits. It's yours. It's real. It's outside the system. And when the system is breaking, when the edifice is crumbling, being outside the system is the only true safety. The banks are buying gold. Central banks around the world are accumulating gold at the fastest pace in decades. Why? Because they can see what's coming. They can see the debt levels. They can see the currency instability. They can see the mathematical endgame, and they're preparing. The question is, are you? Let me give you the final piece of this puzzle, the thing that ties everything together. This isn't a conspiracy. This is a stated policy. CIBC published their report warning about payment shock publicly. The Bank of Canada publishes the data on mortgage renewals publicly. The delinquency statistics are publicly available. The banks are restructuring their operations publicly. Everything I've told you today is based on official data, official reports, official statements. The only difference is that I'm connecting the dots and telling you what it means in plain language instead of the sanitized corporate speak that makes it sound manageable. The system isn't being attacked by outside forces, it's collapsing under its own weight. The architecture was never designed to handle this much debt at these interest rates. The foundation was poured on sand. The linchpin was cheap money, and that linchpin has been removed. What we're watching now is the slow motion implosion of a structure that was always unsustainable. And here's the final crucial point. This isn't unique to Canada. The same dynamics are playing out in Australia, in New Zealand, in the UK, in parts of Europe. Everywhere that housing bubbles were inflated with cheap pandemic money, the reckoning is coming. The specifics differ, the timing varies, but the fundamental problem is identical. Too much debt, too little income growth, too high interest rates, and no way to square the circle. Canada just happens to be further along the curve because our mortgages renew on shorter cycles than American 30-year fixed rates. We're the canary for the broader global housing bubble. And what happens here will be studied as a case study in how financial systems unwind when the math finally breaks. Friends, I want to end with this thought. History doesn't repeat, but it rhymes. And every major financial crisis follows the same pattern: extended period of cheap money, rapid debt accumulation, asset price inflation, policy tightening, and then the snap. We are in the snap phase. The only question is how severe it will be and how long it will last. The banks are preparing, the government is preparing, even if they won't admit it publicly. The question is, are you preparing? Are you stress testing your budget? Are you reducing your vulnerability to interest rate shocks? Are you holding assets instead of claims on assets? Are you stepping out of the line of fire? Because the liquidity tide is going out, and we are about to find out who has been swimming naked. The payment shock is coming. The renewal wall is real. The subprime creep is spreading, and the convergence of forces in 2026 is a mathematical certainty. You can hope for the best, or you can prepare for the inevitable. History favors the prepared, and the window for preparation is closing. The scaffolding is cracking, the edifice is swaying, and when it comes down, the only people who will survive financially are the ones who saw it coming and acted while there was still time. Thank you for being here today, friends. Stay vigilant, stay prepared, and remember, this is not a conspiracy, it is a stated policy. The math doesn't lie, and the math is breaking.